2022 saw the biggest decline in China's economy. Precisely, its second lowest growth in at least 4 decades. This occurred under pressure from antivirus controls and a real estate slump. But with the steady revival of activities, the economic growth has remained slow. The big question is China's high-growth era over? Watch this video to the end to discover. After releasing the World Economic Outlook report for 2023 in October 2022, the International Monetary Fund gave a reviewed and probably final release on this report on January 31, 2023, revising global economic growth for 2023 from 2.7% to 2.9%. China's economy was also revised, increasing significantly from 4.4% to 5.2%. According to Bloomberg, this is the first time the IMF will release a revised version of its growth forecast with raised values. Reason being the rebound in demand in the U.S. and Europe, as well as the improvement in China's outbreak of COVID-19. The report also states that changes in China's outbreak control measures will boost global economic growth and that a weaker U.S. dollar offers a better outlook for emerging market countries with foreign debt. Also, economic growth in emerging markets and developing economies is expected to rise by 4.0% in 2023, but Chinese economists are far from being hopeful. When the whole world went through a major recession in 2008 to 2009, China, through heavy government spending efforts, was able to weather the storm and save the global economy. Because of that, it was expected that, with the world going through another episode of global recession owing to the Russia-Ukraine war and 3 years of the COVID-19 pandemic, China will rise as a savior. But that seems very unlikely. The country's economy expanded by only 2.3% in 2020 and rose to 8.1% the following year. However, in 2022, it came down to 3%. Reducing by more than half of the previous year. In the earlier parts of 2023, growth is projected to remain slow before rebounding in the second half of the year, according to a survey conducted by Nikkei in December. The average GDP growth figure projected by the group was 4.7%, with the vast majority of predictions falling between 4.0 and 5.9%. Yet, even the most optimistic projection for China's economy does not in any way portray the soaring growth rates that the country experienced for decades. Since the economic reforms of 1978, China's GDP has grown at an average of nearly 10% annually, ranking it as the world's second largest economy. The fall of the Chinese economy began with the pandemic. After speculations about its rebound in 2020, repeat crackdowns on the private sector and strict COVID-19 policies have wreaked havoc on supply chains and damaged investor confidence. Little did we know the doom only just began. The country's population declined last year for the first time in 6 decades, raising fear about its future workforce. Now with President Xi Jinping effectively established as China's leader for life, and the country finally dissolving COVID-19 restrictions, can the country ever return to sustaining high economic growth rates? The honest answer is no. According to analysts, China's 10% growth era is most certainly over. The growth rate that China hopes to sustain will mainly depend on how it adapts to the structural challenges facing its economy and the impact of Xi's new priorities. What are the underlying factors responsible for this epic fall? China's years of high GDP growth saw its economy soaring by more than tenfold between 2000 and 2021, precisely from $1.2 trillion to nearly $18 trillion, according to the World Bank's analysis. In comparison, the GDP of the United States, which happens to be the world's largest economy, grew a little more than double of its size in 2000. Over the coming years, however, China's growth rate will slow down to between 2 and 5%, according to economic estimates. Surprisingly, it is said that this sudden fall did not just begin. Michael Pettis, an economist, said that focusing on GDP figures alone is as good as missing the forest for the trees. adding that numbers do not give an overall view, but rather gives an incomplete, time-delayed picture of the Chinese economy. The high-growth era seems to be ending now as per the numbers, but actually in terms of productive investment, it ended around 10 to 15 years ago, he mentioned. GDP, although used to measure economies, is not totally fit for capturing anomalies. This is why the danger of China's soft budget constraints was hidden for the longest time. In China, you can continue losing money for a very long time if it's politically necessary, but it's not reflective of the underlying productive capacity of the economy, Pettis continued. Most economists agree that China's previous growth model worked to boost its economy. But with the country's economy in the midst of a major transition, the future is uncertain. Another significant factor responsible for China's downfall is the aging population and slowing productivity. The unique demographic and economic conditions China leveraged to achieve unprecedented growth in recent decades have slowly faded away. The large labor pools that supported China's low-cost industrial base are reducing as its population ages rapidly. This population decline followed years of slowing birth rates, but only became apparent in 2022. This year, there is no doubt that China will be replaced by India as the most populous country in the world. This has called multinational companies to move more manufacturing to other parts of Asia, such as Vietnam, Malaysia, India, and Bangladesh. A more shocking factor is the failure of China's real estate market. The debt-heavy investments in real estate and infrastructure that are known to anchor China's growth have peaked, yielding diminishing returns. Also, China's total factor productivity, a measure of how much output the economy actually gets in relation to inputs, is no longer growing as it used to. Years before, productivity growth averaged 2.8%, but has since slowed to an average of just 0.7% annually. This has by no small means placed many corporations and local governments at the brink of collapse, further proved by the destruction of the country's largest property developer, Evergrande, in 2021. What can be done to ease this fast-rising economic crisis? Surely the Chinese government can make a few adjustments to ease the transition. Increasing the labor participation rate of the economy is one way, a solution successfully proven by Japan. The government can decide to raise the official retirement age for both men and women to 65. But matter of fact, that might only delay the crisis by parts, as the share of China's population in the 15 to 64 age group gradually shrinks. Another possible solution is abolishing the hukou system, the system that ties social benefits to household registration. Getting rid of this would play a big role in increasing urbanization levels, thereby sustaining China's labor force. The system operates by leaving migrant workers in cities without social benefits like public schooling, serving as a blockade to both present and future urbanization. Automating more manufacturing by building upon China's advanced digital infrastructure could also help maintain industrial productivity. Yet, as much as China seeks to soar again, its leaders have new priorities. President Xi Jinping has shifted the country's policy focus away from a growth-at-all-costs mantra to one that emphasizes high-quality growth, evident in the country's current 5-year plan. Aim being gaining resilience to external pressure and more equal distribution of China's wealth. Simply put, the overall idea of this new policy is to lessen China's reliance on export-driven growth by building an economy sustained in domestic consumption. Developing its own technologies at home has also become top priority for the country, considering the tight export control restrictions imposed by the U.S. aimed at crippling China's chips industry. But can this high-quality growth policy deliver high growth rates like before? We will find out soon, as a world power and economic giant changes in the Chinese economy will leave the world with implications. Although not at the same intensity, the decline of the Chinese economic growth curve will impact the whole world. Many nations, especially those who trade with China and relate with it as their major export destination, will be greatly affected by the heat. The speed at which these nations can dive to other faster-growing emerging markets, such as in India and Southeast Asia, will largely determine the overall effect China's position will have on their economies. China's economic slowdown will also influence the geopolitical power balance. Should China lag economically in the next decade, its goal of surpassing the U.S. as the world's largest economy will be aborted prematurely. This could lead China into taking bolder actions, however destructive, to protect its interest. The collapse of China's economy is a huge phenomenon that would require the best hands to mitigate. What do you think can be done? Do let us know in the comments.